If you look at the analyst price targets for Alibaba stock, it seems like a sure thing. Of the 23 analysts, the lowest target for ticker BABA is to $135 a share, 45% above the current price, and the average Alibaba price target of $178 each would be nearly double your money. But the analysts have been wrong, and price targets have been cut all the way down from over $300 a share to the current price of less than $100 each. Hey Bowtie Nation, Joseph Hogue with a video that many of you have been requesting, an analysis of Alibaba stock, ticker BABA. Should you invest, and when does the stock price stop falling? In this video, I'll show you why Alibaba stock isn't like other investments, why it could realistically go to $500 a share, or drop to almost nothing. I'll share a complete analysis of BABA along with the valuation and whether you should invest or not. We're getting started, but before we do, you know I've got to send that special shout out to all you out there in the nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. I'll be using research from the Webull app for this video. Use the link I'll leave in the description below and get up to 5 free stocks up to $9,600 when you open and fund a new account. Webull is also running a special promotion. Get $5 in crypto rewards with your first cryptocurrency trade of $1 or more. Now, free is always great, but what I really like about this app is the stock simulator that allows me to test out my ideas and track stocks before investing my own money. So check that out with the link below. We're covering a lot of Alibaba stock analysis in this video, so I'm going to leave a clickable index in the description below. We'll start off with the business model and the company's real competitive advantage over its peers. I'll then walk you through the financial analysis, earnings outlook, and the stock price targets. And finally, I'm going to reveal why I call Alibaba a lottery ticket stock, what it means for investors, and whether you should invest. Now, you've probably heard of Alibaba called the Amazon of China, and I guess the comparison is true on their e-commerce similarities, but to understand the real scope of Alibaba, it's more like if eBay, Amazon, PayPal, and JP Morgan all had a baby. Alibaba is everything from e-commerce to offline retail, cloud services, advertising, financial services, and entertainment. And that doesn't even include some of the future growth projects like AI models and autonomous robots. The company dominates 76.8% of the retail gross merchandise market in China and reaches 953 million active users across its online segments. Now, to put that into perspective here, there are only 1.2 billion internet users in the country, so nearly 80% of those with internet access are active users, and the number is even higher at 99% in some of those largest cities. Even US giant Amazon just can't touch that kind of market share, with only about 213 million domestic users, about 70% of the 306 million internet users in the United States. Alibaba grew its domestic traffic by 15% last year and saw international growth accelerate to 37% to a total of 1.2 billion active users worldwide. Now, I also want to walk you through the financial analysis here because this is going to feed into our valuation next, but I know this isn't the fun part for a lot of investors, so we're going to just look at the big picture here. Alibaba has consistently grown its revenue, seen here on the income statement, with 30% annual growth over the last 3 years, though it is expected to slow down into the range of 15 to 20% sales growth to about 135 billion this year. Now understand, these numbers you see here are all in Chinese yuan, so I'm going to be dividing by 6.3 to get you a dollar figure that I'll share. Now against that sales growth though, we are seeing operating profits fall in that bottom line. Now the cost of goods, those supplies and production costs, they have increased because of inflation, but the bigger reason here is the company's marketing and other administrative expenses have just ballooned higher. The fact is that Alibaba is facing a lot more competition over the last couple of years, so marketing expenses are heading higher, but its other operating costs are also increasing as it has to deal with more regulatory oversight from the government. The company still produced over $27 billion in cash flow from operations over the last year and was able to invest $22 billion in new technologies, research, and development, something that is going to enable it to grow those special projects like autonomous, AI, and cloud services for faster growth. What really surprised me though, looking at this company's balance sheet, Alibaba has over 483 billion won or $76.7 billion in cash against just 26 billion in long-term debt. So the company has over $50 billion in net cash reserves. Now remember, we're talking about a company with a market value, a market capitalization of only $240 billion here. so more than 20% of the stock price is backed by cash. Earnings are expected lower this year to about $8.35 a share, but then to grow by 11% annually to $11.40 a share through 2025. We're back on that competition theme, right? Competition continues to increase, and Alibaba's dominance in retail has come down a bit, but it's proving to be very sticky among consumers. And despite the government's best effort to increase competition, Alibaba reported over 96% customer retention over the last year in its mid and high spending customers, shown here on the right side of the graph. Only those spending less than about $300 a year had lower retention, choosing to jump to other sites rather than stay with Alibaba. Nation, the fact is, for the Chinese consumer, Alibaba is online shopping, and competitors are finding it very difficult to win that market share. Not only that, but the company is better monetized than its competitors, reporting sales of $122 in gross merchandise volume per active user versus just $73 per active user at JD.com, its closest competitor. Against those sluggish profit forecasts, analysts do expect revenue to continue higher from $135 billion this year to a 15% annual pace to $206 billion through 2025. So sales growth is still there, even if expenses and compliance on antitrust issues are causing that profitability and the earnings to take a hit. Now, putting some of this together, on that valuation side, Alibaba stock is trading for just 10.5 times on a price to earnings basis, and at a price of 1.75 times its expected revenue for this year. To put that into perspective, shares of Amazon at nearly $3,000 each are trading for a price of 60 times its earnings and for 2.9 times on a price to sales basis. And now let's be clear here, I don't actually think Amazon is overpriced here either, at just 3 times on that price to sales basis. But even this is still 65% more expensive than shares of Alibaba. On similar price multiples with Amazon, shares of Alibaba would be between $145 to $500 each for as much as a 470% return. We can also compare Alibaba's price multiples to its own history. Here in the top line, you can see the stock has traded for a price to sales ratio as high as 14.8 times in 2017, and besides last year, was typically priced around 7 to 8 times its revenue. On a price to earnings basis, shares have been as high as 48 times, but even that 2020 valuation of 23 times PE would mean a $195 stock price right now. And you see that valuation reflected in these analyst price targets. With 23 analysts pricing the shares, even the lowest target calls for a 45% increase to $135 per share. The average price target of $178 would be nearly double the stock price, and one analyst pegs the shares at $250 each in the next year. But then, of course, the question is, why does Alibaba stock continue to fall when it's so undervalued? Now, this started in 2020 when China started cracking down on its tech giants, culminating in a historic $2.8 billion fine on the company's business practices that were pushing customers into different business segments. Now, it does appear that most of the crackdown and those investigations are over, though they're still seeing some of the after effects and the heightened competition and those expenses hitting profitability for the company. And more recently, and probably even worse for the shares, has been the slow progress by Chinese regulators to allow its companies to comply with a 2020 law here in the United States. Now, that law, the Holding Foreign Companies Accountable Act, or HFCA, I guess, requires U.S. stock exchanges to remove any stocks of foreign companies that do not allow the U.S. Public Company Accounting Oversight Board, that's the PCAOB, to verify practices by its auditor firms. Now, the law gives companies 3 years to comply, after which their shares are removed from the U.S. exchanges. And just last week, the Securities and Exchange Commission released a list of the first 5 companies at risk of delisting as soon as 2024. These were Beijing Ltd., ticker BGNE, Yum China Holdings, ticker YUMC, Z-Lab, ticker ZLAB, and ACM Research, ticker ACMR. Now, on that news, almost all Chinese stocks listed in the U.S. exchanges dropped like a rock, including a 9% plunge in shares of Alibaba on fears that more names would be added to that watch list in the next few months. For its part, Alibaba says its auditors are keeping with PCAOB requirements, but the company is still listed on the regulator's website as a company denying oversight to those auditors. Here we do see that PricewaterhouseCoopers audits Alibaba's financial statements, so it's a reputable accounting firm, but the U.S. regulator is still unable to verify those statements, putting Alibaba's shares at risk of delisting in the future. Now, on Friday, the China Securities Regulatory Commission responded to that SEC report, saying it was confident it could reach an agreement to avoid delistings and that talks had made positive progress, but the threat is still there. So with Alibaba stock, it's not so much that question of valuation and the patience to wait it out until the market comes around to the stock. You look at other deep value stocks like Teladoc or Groupon, and I know that eventually investor sentiment will improve, price multiples will increase, and the stock prices will follow. With Alibaba though, it's not a question of valuation, but whether the stock will even be around in 5 or 10 years. Whether it gets delisted from the United States market, and even if it remains listed, whether something might happen between China and the US that causes shares to implode like what we're seeing with many Russian companies right now. That means Alibaba is very much a lottery ticket investment. If it remains available to US investors, if it's able to continue growing without the Chinese regulators trying to hobble the company, then you're going to see the valuation come back into these shares, and this stock is worth at least $383 each based on a 5x sales multiple and a $206 billion in sales in 2025. That is a 335% return, or 62% a year, if the shares are still around for you to sell. Now, on the other hand, if the shares are delisted from the New York Stock Exchange, you will still own that stock, but it's likely going to be traded on Hong Kong exchanges or on the OTC exchange here in the United States. Now, most institutional investors like pension funds and wealth managers aren't allowed to invest in OTC listed companies, so there could still be a massive selling of the stock, and while it wouldn't go to zero, it's very likely this could be less than a $50 stock. So here you've got two very different scenarios and price forecasts for shares of Alibaba, one for a spectacular return and the other one that loses 40% on your money or more. So how do you decide whether to invest in Alibaba or not? And First Nation, you have got to understand yourself as an investor and whether you even need the stress. It is an amazing potential return, but the risk is also extremely high, and some investors, in fact, probably most investors, just don't need that level of risk in their investments. Listen, there are plenty of other great stocks out there that can double your money or even more over the next few years. So stocks like I said, Teladoc Health, Groupon, PayPal, Canopy Growth, that are all trading well under their fair value estimates, but don't have that kind of risk that could take the shares down another 30 or 40%. The other question to answer here is, what is that likelihood of the different outcomes for the stock? And maybe it's coming from a long, proud line of degenerate gamblers, but I need to know the odds on any investment. What is the probability of success here? And here, even if I think the odds are maybe 50-50 at best for shares of Alibaba staying listed on the US market, that's still 50% times a price target of $383 a share over the next 3 years, or about $191.50 a share. Then if the other 50% chance is on that stock is delisted and drops to $50 each, we add the two of these together to get that probability weighted target of $216.50 per share. Now you probably want to refine those odds with what you think are the chances, and maybe even put price targets on a few other scenarios, or maybe a longer term timeline. For example, if shares are delisted and you're holding them for another 5 years on that OTC exchange, maybe that the valuation still improves, or maybe eventually they get listed back on the NYSE. Now for me though, as an investor, the valuation has just gotten so ridiculously cheap that this risk is worth it. With a 3-year price prediction upwards of $400 for Alibaba stock, I can take a little more risk for that kind of a return, and actually did pick up 100 shares last week for just under $9,000 in my own portfolio. Click on the video to the right for a full analysis of PayPal stock and why I'm investing for a 377% potential return in the shares. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.